This is NTV.
Folks, you are just in time for your weekly most comprehensive look at the world of business, finance and economics. Welcome to another episode of Business Redefined. Tonight, we want to dig deep into the latest raft of proposals we have seen from the National Treasury as far as tax laws are concerned. We have seen the Tax Laws Amendment Bill, the Tax Procedures Amendment Bill. We have seen the Business Laws Amendment Bill. And of course, there's a fourth one which we won't be touching on tonight, but that's the Public Finance Management Amendment Bill. To make sense of this, I'm joined by an eminent panel, starting with Edna Gitashu from PwC. Karibu sana.
Thanks for having me.
She's the tax policy lead. I have Hadija Nanyomo from EY, where she's the partner in charge of indirect taxes. Karibu sana.
Thank you, Julian.
Glad to have you here. And finally, we have Robert Oreiro, founder, Ichiban Tax and Business Advisory, as well as chairperson, ISPAC Public Finance. You're welcome, sir.
Thank you.
Ladies and gentlemen, welcome on set. There's a lot of anticipation on this conversation in terms of what the proposals are, what they mean for Kenyans. Let me start with Robert there. Which is your biggest highlight in terms of a positive in these bills, and which do you think will be the biggest pain point?
Right, Julian, thank you very much for this opportunity. And to your question, what is the biggest highlight? I think in these bills, let me call them bills because there are many, the biggest highlight for me is for employees. I think employees have come out much better than they have in recent years that we have seen. You know, whether you're looking at the expansion of the tax-free benefits for meals, for pension contributions, for non-cash benefits. So I think that is a real major win for employees, because if you look at what's been happening recently, a lot of raiding the pay slips, as it were. Yes. Yeah, so that's a good positive. For me, I think one of the biggest losses, I think, would be around advanced pricing agreements. The Finance Bill 2024 had that provision. And it's sad to see that it's not there yet. We are going very big in terms of aligning with what is happening globally. So I think that's for me is one major one.
Now that you've mentioned that, Robert, allow me to stay with you for a while. Is it a case of same script, different cast? Is this Finance Bill 24 by another name?
No, I actually don't think so. And Julius, I think it's important to give government its flowers. They have really tried to remove some of the controversial provisions. For example, motor vehicle circulation tax is not there, VAT on bread is not there. But it didn't
make sense to begin.
I agree, but the truth of the matter is, those provisions are not there. So I think this one, people can have a conversation, a good conversation, without being emotive about it, I think, because some of those controversial provisions are no longer there. So in my view, still not where we need to be, but certainly much better than the Finance Bill 2024.
All right. Hadija, your brightest spot, your biggest pain point?
I think for me, I want to look at it from a point of contraction of the economy, a depressed economy, and the fact that we are seeing a lot of businesses closing down. We are seeing a lot of people losing jobs. So when I look at the fact that finally they are trying to listen and make transfer of a business as a going concern exempt, I see it's going to unlock a lot of M&As, mergers and acquisitions. Yes. It's going to at least try and attract more FDI, because in the business we sit in, we see a lot of companies out there doing due diligences, trying to see if they can come into Kenya, and it makes a big deal if they have to pay the 16% VAT on the sales. So for me, I feel this is a good one, and it may unlock a few investors into the country. But when I look at the flip side also, there are few areas still around indirect taxes, that is like the excise duty. I feel like excise duty is really being used as, we are no longer going the theoretical way, the academic way, the rationale, the principles behind taxation, and reasons why a certain tax is supposed to be brought on board and how it should be employed. When I look at many of every year you just see another new excisable item coming on board. No much of rationale. You just see a raft of them, and now the way it's coming through is through importation, sort of like protectionism, or protecting the local people in the country and the local investors, which to me feels like it's going to have quite a bit of beating to the economy, especially seeing we are now trying to integrate. I think the other day we were hearing about BRICS, Kenya joining BRICS. How are we going to work with others if we are protecting ourselves and throwing stones at glass houses. So I feel like, for me, there is need to really rethink about the introduction of the so many excise duties on goods.
But Adija, just to, the counter-narrative to what you're saying would be that, look, we are in an environment where we have had multiple successive shocks. And the government's argument has always been that the easiest, most efficient way of mobilizing domestic revenue is to reach for indirect taxes. And I had an interview with the Revenue Authority where they indicated that, look, the idea that excise is purely sin tax is really an idea of the past. Increasingly, especially in the global south like Kenya, we are using it to ramp up collections.
I think for me that's valid. It's a valid point, and it's something one can really argue. But from where I see it, when you look, if you go back to principles again, for you to get good milk out of a cow, you must feed it. Who pays this indirect tax? It's all of us, the consumers. And if we are being depressed and we don't have that disposable income, it's going through AHL, it's going through SHA, it's going through the 35% increment in pay, it's going through all these, taxes that are on individuals, then what am I going to be left with to spend indirectly on these goods that are sort of like for consumption? So again, it goes back to the rationale and how taxes should be arrived at and the system through which taxation should happen. So yes, it's valid, but when you look at which items have come through to collect excise duty and how much of it, today I was reading the papers and it was reported that VAT has gone down by around 2.7 billion. It has gone down, why? Because people are not consuming. There's no disposable income for people to consume, and that excessive, taxation from a VAT perspective is affecting everything that we can think of. So for me, from where I sit, yes, there's the sort of the goodwill from government. We know we have problems, and we have really a problem to solve. But we need to think through, and we need to justify and look at the rationale.
All right.
Yeah.
And just to clarify, when Hadija talks about transfer of business as a going concern, that's part of the changes we are seeing in terms of value-added tax. Currently standard rated, the proposal is to take it to exempt category. Let me switch gears now to Edna Gitashu from PwC. Your brightest spot, your biggest pain point.
Thanks, Julian. Just to pick up from where Hadija has left, the fact that there's an attempt to increase the disposable incomes of individuals, similar to what Robert has said, that's a plus for me. And we look at this from the perspective of employees. They now have relief from the affordable housing levies and SHIF, that's a social health insurance fund. So what that means is that their tax base is going to reduce by the amount that they are contributing towards the levies, which is a welcome move. If you look at the pensioners also, the pension taxation regime has been exempt at the point of contribution up to a maximum of 20,000. There is a proposal to increase this to 30,000. Then the investment income is also exempt, but at the point of withdrawal from the pension, then you're subject to tax. And at that point, that is when the senior citizens actually need more money for upkeep. So the fact that there is a move from taxation at the point of withdrawal to exemption, that's a big win for the senior citizens. The biggest loss, in my view, if you look at the medium-term revenue strategy,
MTRS.
Julian's, it had a matrix, 3-year implementation matrix. And if you look at the 2024-2025 schedule, one of the things that was supposed to be reviewed are the tax bands for individuals, the pay-as-you-earn tax bands. So I thought this would have been a very good opportunity for the government to also review these tax bands, although I understand that we have constrained fiscal space, but it could have been an opportunity to also review these and see whether there would have been some additional reprieve given to individuals.
Edna, so is finance bill back, 24?
I don't think so. I think what they have done is to bring back the good proposals from the Finance Bill 2024, and what is missing are the contentious proposals that were there.
We're talking about one of the celebratory points in this bills, especially the tax laws amendment bill, being the allowable deductions, affordable housing. Robert, do we fundamentally have a challenge as far as the drafting of the allowability of affordable housing levy as a deduction is penned, if you look at the tax laws amendment bill, because it seems to be constrained to only those who are on payrolls, and yet from all the guidance you have received from the Revenue Authority, even if you're on something like rental income, you should be deducting this?
Yeah, I think that's a very good question, Julian, and probably the reason why we need public participation. And I agree with you. I think there is a drafting, shall we call it a misnomer? Because I would want to believe that it was not a deliberate. So what you're talking about is the deduction for affordable housing levy is granted on the basis of Section 51A of the Affordable Housing Act. Now, 51A is the one which says, as an employer, you remit the deductions that the amounts that have been deducted from the employee. The problem that we see with that drafting is that it then just focuses on the employee only. So if I've got rental income, which I don't have, by the way, but if I've got rental income, it means that I still need to contribute affordable housing levy, but I don't get the same benefit. And therefore, we can see a potential challenge from a discriminatory perspective. You remember all these disputes that we've had in the finance bills, it's discriminatory. In fact, even the affordable housing levy was first thrown out on the basis that it's discriminatory.
Correct.
Now, Section 42A, 42A is for employees, 42B of the affordable housing levy is for self-employed persons. So the question is, do self-employed persons also get that deduction? And I believe they should get. So that's one of the things that we need to engage on in terms of public participation. But there is a problem.
But what's the practicality of the administration of the affordable housing levy on the self-employed?
Well, Julian, it's the same thing about personal relief. Self-employed people don't get a monthly personal relief, but when you're filing your return at the end of the year, you claim the relief. Yeah. So again, you just claim the entire deduction.
I like that. I'm surprised that no one has said that their brightest spot, and that gives us a segue to the next point, is the tax amnesty. I mean, the extension of the amnesty to June 30th, 2025. Khadija, what do you make of this?
I think an amnesty is something given for you to declare where you feel you're wrong. First of all, you need to know that you are wrong. You need to find out you are actually wrong. And then you need to find out how wrong you are and then declare it. So I feel like many of the taxpayers had taken it up and they had embraced it and they had declared. A few were not yet, maybe were caught up by time or needed approvals or needed, for you to get it, you must pay the principal first. Yes. So I feel like for me, this is also a welcome move. Will it generate as much revenue as anticipated?
They're targeting 30 billion.
I'm praying it does, but I feel like many of the taxpayers took up the opportunity and declared this. So for me, I think it's a welcome move. There were few sticky points around it in implementation, even the procedure, the sensitization around how you go about it. And I'm looking at people like most SMEs who may want to come clean. I don't feel like there was enough time to really sensitize, especially system-wise. When you've come up with the taxes, how do you go to the system? When do you pay? And what comes next and all that? And are there team members or professionals from the Revenue Authority that should guide people like those? Is there an outreach where you're going to have a roadshow and tell these SMEs, people who want to really comply, that they should come up and declare? So I feel like, and I'm hoping that the government will come up and now clean up some of those areas that needed cleanup. And I believe maybe the revenue should come in. Because when I look at the obvious targets all the time, the large taxpayers, they may have been saturated now and they did what they need to do. So most of this money should be coming from informal sector, MSMEs, and individuals as well.
I see.
Yeah.
But by the way, the earlier phase of this amnesty targeted 51 billion, they registered 50.5 billion, almost 99%. But Edna, there are those who have argued that maybe we need a change in the base period from DEC 31st, 2022 to DEC 31st, 2023. Is there a case there? Because it's not in the bill.
Yeah, Julius, I think there's actually a case for that. If you think about it, the amnesty was running from September last year all the way to June this year. In September, there was a delay by the Revenue Authority. The systems were not ready. So there was a bit of delay, and taxpayers were not able to take advantage of the full 10 months that were provided for. So there were those taxpayers that were locked out. So that's why the amnesty is a welcome move. But secondly, to your question around the base, I think if we are extending the period of the amnesty to 30th of June 2025, we should also consider the base. We moved from end of December 2022 to end of December 2023. And a lot of things have happened, and over and above the amnesty, maybe something else that the government needs to think about. We are now migrating our legacy balances.
Correct.
And these legacy balances are coming from a change in the filing platforms. So we initially had the manual filing platforms, we moved to ITMS, then iTax.
Yep.
And now taxpayers are being hit with legacy balances arising from manual filing or ITMS, in some cases more than 20 years, and will not be able to get this information. The Tax Procedures Act is very clear that you're only supposed to keep records for 5 years. So I think the government should also consider, over and above the amnesty, automatic abandonment of collection of this principal tax and the penalties and interest for taxes that are actually coming from the legacy balances and are more than 5 years old.
Treasury, when I raised this issue of the base period with them, they said, look, that will be opening a new amnesty by itself. Please note, we are targeting extension of the lapsed amnesty. We are not opening up a new amnesty because you'll create perverse outcomes. Taxpayers will get habituated to the expectation that there will always be an amnesty.
Yeah, so Julius, they do have a point, but they have already opened the door for this amnesty. So why are you opening the door for the amnesty and nobody is going to take it up, or you'll have very few taxpayers taking it up? So let's also change the base to 31st of December 2023, and then we can be able to deal with some of these other issues that are cropping up.
Robert.
Yeah, I mean, Julius, I completely agree with Edna here. In fact, I would go as far as saying, let's look at history, because, you know, it's important for us to understand the context of these amnesties. Kenya has had about 5 or so amnesties, some of them not as successful, like rental income amnesty. However, if you look at the amnesty that came in Finance Act 2004, that was by Muraria. If you read that act, it says, remember the budget day was 11th June 2004. It says any VAT due before 11th
But
June.
you've been doing tax ever since.
Yes. So any VAT due before 11th June 2004. Then for income tax, it says taxes due before 31st December 2003. What does that tell you? The amnesty was crafted to be as recent as possible. So there's actually a lot of sense in making this amnesty come up to, in fact, in my view, even 30th of June 2024. Why? Because you're asking people, guys, let's draw a line in the sand. Anybody who's not being compliant, let's draw a line in the sand. After that, we come for you in terms of penalties and interest. Yeah. And I can tell you, like my colleagues have said, there are a lot of people who want to comply. Of course, there's an issue of tax morale, but the people have been given an opportunity to comply. So if you don't then comply, there's really no question about the imposition of the penalty. So I really hope that government is listening and can extend this to 30th of June 2024. But
how do you respond to the argument that, look, we gave you guys the voluntary tax disclosure program, it ran its course, we came to this tax amnesty. At some point, I think in FY 22-23, we had a 60-40 kind of arrangement in terms of amnesty. Look, guys, we've given you enough window for this.
And I think that's a fair point. What I'm just saying is, because there's a proposal for an amnesty, and we're looking at, you know, the essence of this publication is so that we can have a discourse and improve it.
Ventilate.
Yes, ventilate and improve it. So we are saying, perhaps one of the improvement points is bring it up to, June 2024, 31st December 2023. Let people pay their taxes, and then after that, let's enforce the law properly. And like Edna has said, because she's raised a very important point about legacy. In fact, if you look at that legacy balance, it was posted on People's iTax on 28th of June. Now the amnesty is expiring on 30th of June. What do you want me to do?
Yeah. And by the way, the deadline, if you look at the notice from the Revenue Authority around this legacy transition from legacy to iTax is DEC 31st?
Yes.
2024. Hadija, did you want to chime in on the base period of the amnesty or not?
No.
Not at all. So, ladies and gentlemen, we have the conversation around e-teams, which many small businesses have written to us about. And one of the major developments we are now seeing is the provision for reverse invoicing for any business whose turnover is $1 million and below. Hadija, is this a hit or a miss?
Reverse invoicing, I think, is again coming to the burdens that are given to those that are capable, Because what I would understand with that, if you're dealing with someone who is not capable of doing it, and for you producing that invoice, the e-invoice, and for you're a big organization, you're read on e-teams, and your systems are already set up, then it means you can invoice yourself on their behalf. And the reason for this is ideally to enable you to claim the deductions from a corporate tax perspective and any other perspective, maybe even VAT or by itself. But the question is, how much is a business going to take on? Because this is, again, agency taxing.
Yeah. You're
giving a responsibility to someone who is already doing withholding, who is doing pay as you earn, who is doing withholding income tax, who is doing VAT, and now within VAT, there's also withholding VAT. The same person is doing that. Now they have to do reverse invoicing. And it seems like most of the entities have had to create fully fledged tax teams, because the nature of tax heads, the nature of different nuances within the tax system has forced them. I think it's good, it may help, and it may help especially the large taxpayers or those who are already established to be able to get these invoices for income tax purposes in time. But again, I feel it may be a bit of a burden. I don't know which is simpler, for this to happen and the burden is thrown to the taxpayers who are complying, or to try and support and bring what my brother Robert has said is the tax morale and, bringing everyone to the plate, including the informal sector, those who can't, because how long are they going to be fed and babied?
I see. Before we move any further on the conversation on e-teams, I'd like us to take a very quick break. When we come back, I'll be getting thoughts from Edna and Robert as far as e-teams, reverse invoicing, and many other issues around e-teams are concerned. But for now, let's catch a break. We shall be back with a lot more on this conversation. Welcome back to this conversation on Business Redefined. We are unpacking the recent tax laws amendment proposals coming from the National Treasury. Before the break, we had begun our conversation on electronic tax invoice management system, and Hadija had already given us her thoughts as far as reverse invoicing is concerned. Let me switch gears now to Edna. Reverse invoicing, game changer or not, and how could we streamline this further?
Yeah, so Gillian, thanks for that. I first of all think that this is a step in the right direction. And why do I think so? When it comes to implementation of technology, it is not cost-free. There is a cost attached to it, both from the Revenue Authority perspective and also for taxpayers. The larger taxpayers have more financial resources and are able to implement the electronic invoicing and any other technology as compared, with relative ease as compared to the smaller businesses. So what ideally would happen, because remember under the Income Tax Act, you cannot claim a deduction if you do not have an electronic invoice.
Yes.
So ideally what would happen is that if you're doing business with a large business, that large enterprise will be asking, do you have an electronic invoice or not? So what will inevitably happen is that the small businesses will be thrown out of that trading ecosystem.
Yeah.
And they will go under the radar. So what would you rather? Do you want to gain visibility of these businesses that are actually trading with the larger enterprises, or to lose that visibility? Because they do not have the resources for electronic invoicing, I think it is a good idea. And we have actually seen this practice in other countries. It's a very good idea in my view to then allow the larger businesses to do the reverse invoicing for them. Now the challenge we have, Julians, still on that e-teams provision, it requires a bit of improvement. So one, when we talk about the threshold of 1 million, it is not clear. The wording of the law does not indicate the timing of this 1 million. Is it per month? Is it per annum? My guess is that it is per annum, but the law needs to be tightened and cleaned up to introduce that. The second thing is the large businesses will then have a headache to ask, how can I confirm Hadija's turnover being 1 million?
Yes.
Maybe Hadija is trading with me and her turnover, according to me, is about 500, but she's also trading with Robert, and the turnover is more than 1 million. So how will that large business be able to confirm that? In my view, the solution is actually to peg that on the VAT threshold. And the simple question that the large businesses will be asking is whether there is VAT registration on that small taxpayer, and that is how they'll be able to confirm whether they've hit the threshold or not.
But you'll be bumping it up to 5 million in that case. And Edna, I'd like to imagine the reason why the million is there. One, we have guidance from turnover tax. We know the band within which it plays. Then secondly, we saw this amendment coming in the third reading of the Finance Bill of 24. And when it was introduced, it was $1 million per annum in turnover. So I'd imagine that we're not debating whether this is $1 million per day or $1 million per month or per annum.
So Julians, the message is very clear. Tighten the law.
Yeah.
My guess is as good as your guess that we think it's actually 1 million per annum. But you know, when it comes to interpretation of tax, it's not about the spirit of the law. It is actually the letter of the law. So that needs to be cleaned up. And if you think about it, Julians, maybe another point. If you think about the small traders, if these small traders are not able to raise electronic invoices to the large businesses, what about businesses between the small traders themselves? So
yes.
Maybe that is why the threshold of about 5 million would be okay, so that we can already exclude these people. And remember, they are paying turnover tax, so they do not require an electronic invoice to claim any business deduction.
I see. Robert, a different question to you. Why not just amend Section 16C of the Income Tax Act and stagger the implementation of the rollout of e-TIMS?
Well, I think that's an interesting point and probably something that we should consider. Because you see, Section 16(1)(c) says you cannot take a deduction of an expense if you don't have an e-TIMS. Now, like the point that Edna has made, these small businesses, I want to trade with them, but for me to trade with them, I need to give them the reverse invoice that I have generated for them. And I think there are practical challenges around that, particularly for businesses which want to support small businesses. Take, for example, you've got a hotel that is somewhere in, I don't know, the Masai Mara, and they buy cabbage or greens from a local supplier. Chances are that this local supplier doesn't get to $1 million. And so you need to ask, do you get to $1 million so that you can raise the invoice? So there's a lot of implementation challenges, and which is why I agree with you. Probably the thing to do is to say, let's amend this Section 16(1)(c). Let us face it, because anyway, even the implementation of e-TIMS has been a bit challenging. Yeah. I think the last statistics or so were about 30 or so % e-TIMS registered persons. So then we understand that KRA is looking for visibility. And if you look at these proposals, there's a lot of proposals around visibility. You know, they want integration and those kind of things. So my view is that you probably don't get visibility only through the e-TIMS. You can get visibility through other methods. For example, that they want to integrate with financial institutions. They probably want to integrate with telcos. So when I pay through the system, then you'll still be able to get the visibility. So I think there's something that we thought about deleting or facing at least the implementations of Section 16(1)(c).
I see. Anyone who would buy into that? Yes, Adija.
I think for me, I'm really liking it, but I'm hoping that government will also implement and use the data that they get from it to widen the tax base and get more revenues out of the small taxpayers. Because if you have 1 million, and as Edna has rightly said, you're expected to be paying turnover tax. So what this will do is that if I reverse invoice you and you've not remitted, you've not been remitting turnover tax, you've not been paying any other tax you should pay, even pay as you earn for employees or whichever tax it is, I'm hoping that there will be a back system within the Revenue Authority that will be consolidating all this and bringing these people into the tax net. Because that is the idea. But again, have we thought beyond this reverse invoicing and using the data to generate and bring more people into the tax net?
On that note, by the way, is this where Section 59 of the tax procedures around data management and reporting system comes in, or how does it play out? Robert?
Yeah, I mean, so Section 59 and the proposals around the Tax Procedures Act, KRA is saying we can give you a notice requiring you as Julians to integrate with our systems. And the requirement is that we give you a notice of not more than 12 months for you to integrate, and then you have to have a turnover of more than 5 million, which is the reason why you can hear the conversation about the 5 million. Now, the challenge is this, Julians. I could actually have a business which is doing 6 million in turnover a year, but I do manual invoices, or now because of e-TIMS, I am doing them on e-Citizen. So the question is, when you're asking me to integrate, I don't even have a system for you to integrate, which is probably another reason why we need a phased approach, so that you say, let us, the reason why KRA has organized itself into large taxpayers, medium and small, is because each of those sectors has got unique requirements and unique capabilities, like Edna said. Yeah. So let us say, let's integrate with the large taxpayers, because anyway, even using the Pareto principle, that's where most of the money is coming from a tax perspective. So let us integrate with these guys and let us see the way they're doing with banks, for example. Then you move into the smaller spaces as you go along. But as it is right now, you probably could be running a small business and you're asked to integrate. What are you integrating?
I see that point, Robert. So let me ask now that you've raised that, and help me make sense of this, because I was reading the proposals around e-teams and wondering, Section 23 of the Tax Procedures Act makes it mandatory for all businesses to issue electronic tax invoices. Then now we're talking about a threshold of 1 million for reverse invoicing. Then if you read further, then there's a 5 million threshold for integration in case KRA reaches out to you. Is this something which is contradicting? Is it properly scripted, or how do you guys make sense of this?
Yeah, so Julian, these are different provisions.
Okay.
So the provision on the 5 million threshold is Section 59.
Yeah.
What is proposed to be Section 59 of the Tax Procedures Act. And that one is for integration between the Revenue Authority and particular businesses. It's not all businesses. Mm-hmm. So what I guess will happen is that the Revenue Authority will look at strategic businesses. And for those strategic businesses, the reason why they have a threshold of 5 million is to make sure they have the financial resources and the personnel and all the resources required for the integration. Yeah. So they are able to integrate and create visibility of transactions at the Revenue Authority level. That is one separate provision. When it comes to Section 23, you're right. So long as you're doing business, then you're supposed to have an electronic invoice, to issue electronic invoices. But remember, the same Section 23 has exemptions in it, and also empowers the Revenue Authority to issue guidelines. And we already have the regulations on that. And we've seen certain institutions are already exempt from the requirement of issuing electronic invoices. So there is no contradiction in my view.
Okay, okay, makes sense. Was anyone else as surprised as I was that we did not see the revision of the VAT threshold as we had seen in Finance Bill 24? I don't know who wants to go first here. Adija.
That was a bit heartbreaking. Because when you look at the economy, and 5 million has been forever, and everyone was excited that it would go to 8. But again, even if it goes to 8, it may not leave out many people. And they've already taken care of the low revenue taxpayers, the ones that fall under the turnover tax. So whereas it was a bit exciting, it's not so much. But I know people like us, individual consultants, if there's an individual consultant, they may be happy to move out of the 5 to the 8 for obvious reasons. It's not a small amount per year. So I think it was heartbreaking, but probably they felt it wasn't. You know, when you have so many issues, you have to know where to focus and what to prioritize. So probably they felt out of the huge, so many pages of the Finance Bill 2024, they can leave that aside and look at the hot topics like what Edna was saying. Because I feel like this is a mini Finance Bill 2024. Maybe the rest will be crawling in a bit. They'll be slowly crawling in as we go ahead with the year.
Were you surprised, Robert?
No, I was not really surprised. Why? Because VAT has been a pet subject for government, and especially when you look at reducing the leakage. There's been a lot of talk about the amount of tax expenditure, the tax foregone from a VAT perspective. So just like Hadija says, I think the focus was, let's first of all tighten the ship and ensure that we have no leakages, so that by the time we are then cleaning up the tax register and excluding some people because it's a bit more, shall I say, expensive for them to comply with the VAT compliance, we have a better handle of VAT. And by the Julians, there's an IMF study which shows that across Africa, the VAT efficiency is about 37%. So that says, and this is a November 2024 study, that shows you that there's still a lot of potential in terms of VAT. So let's first of all sweat VAT as much as possible, then we can deal with the thresholds. I think that's a view.
But Edna, what does this mean in terms of the sequencing? You remember the MTRS, which you talked about earlier, and we have the implementation matrix. There's a reason why that proposal to bump up the threshold from 5 million to 8 million was in Finance Bill 24. Because next we were expecting that the rate would come down from 16 to about 15 or 14%. Where are we left with this implementation matrix, Edna? And
actually, Julian, if you look at the implementation matrix for 24-25, two things were supposed to happen from a VAT perspective. One was a threshold, was supposed to go up to 8 million. Then secondly, besides the threshold, there was supposed to be a reduction of the rate by 1 percentage point.
There you are.
To come down to 15%. So maybe because of the constrained fiscal space that we are in, the government might be rethinking this, but I hope that this is going to be considered in the next finance bill.
So it didn't catch you by surprise that this thing was left out?
Well, I was expecting it. I was actually disappointed that it wasn't there.
Now that we're on VAT, Robert, Section 17 of the VAT Act, and anytime I put this point out, as I did earlier in Finance Bill 24, many Kenyans ask me, what is this VAT apportionment formula all about? So maybe just give us an explainer, first of all.
Okay, so Section 17 is of the VAT Act allows a registered person to claim input VAT. So that's the starting point. And then it goes on to say, you could be registered for VAT, but you are making mixed supplies. Mixed supplies meaning you've got standard rated supplies at 16% VAT, you've got zero rated supplies which are VATable but at zero, and then you've got exempt supplies. Yeah, and it says to the extent that you've got exempt supplies and you're using inputs that have VAT, we will restrict the amount of VAT that you can claim. Because in an ordinary setting, you are allowed to claim input VAT because you're making output VAT or you're making VATable supplies. So it says, currently the provision says, if the ratio of your exempt sales is 10% or less, then you can claim the entire VAT.
Yeah.
So what this provision is, the proposal is saying is, we've been losing some VAT. If you have exempt sales at 8%, we will not allow you to claim VAT of that 8% because currently you can claim it. Yeah. The same way that if your exempt sales are 12% of your total sales, you can't claim 12% of your input VAT. So it's really driven by
the rationalization
of the expense. And if you listen to the CS and the government, they've basically been saying, we've been losing a lot of money in this space. So we want to reduce that because anyway, the way VAT is supposed to work is input-output. Yeah. So if you've got exempt supplies, then don't claim the input VAT, which is probably a big issue now going forward. If the proposals around fertilizers, around agrochemicals and those kind of things, if they go through, that will be a big issue for that sector.
So, Hadija, when Kenyans look at this, first of all, who should be taking note of this, and do you see it as a positive move, or how do you assess it?
I think for me, if I'm being fair, it's going back to the canons of a good tax system. It's supposed to be fair. This was in a sense that if you have 90% of taxable sales and 10% are exempt, it means you're going to claim 100%. More than 90%, you're claiming 100%. Yeah. So there's a 9% or 10% you're gaining, which you shouldn't. But on the flip side, if you have 10% or 9%, you're claiming zero. So for you, you're losing. So for me, I feel, whichever way it looks, there was a bit of unfairness in the system. And I'm happy that this is going to come to a place where it is fair and proportionate. But again, when I look at other countries, like I remember when I was in Uganda at that time, there were two methods. One needed to opt. There was this apportionment method, and then there was the alternative method, where you would do what now the bill is suggesting, to apportion, but without having these limits of 190% and 10%, or the 80 and 20 we had before. It's alternative, you apportion directly. Whether it is 1%, you claim that 1%. If it's 2%, which is taxable, you claim the 2%. And I feel for me, it's just purely from a point of fairness, and us going back to the canons of the good tax system. Yeah. I think this is a good start. I'm hoping that the government will now start following another canon, which is predictability, which is simplicity of the tax system. and very soon we'll be there.
Edna, on Section 17, are we then saying that the premise upon which we framed this Section 17, and which has been around for a while, was almost a frivolous premise, and now we are here to try and ensure, as she says, that we have fairness in this administration?
Julius, I don't think it's a frivolous provision. It's a provision that gave an almost like a tax incentive to everybody who was doing business, mixed supplies business. You had your taxable supplies and you had your exempt supplies. And to reduce the administrative cost of apportioning this restricted input tax, then there was that leeway. That so long as you have that threshold of 90% and above, you can claim everything. So I think it's more of expenditure rationalization. We have been talking about expenditure rationalization, increasing our tax to GDP ratio, and this is one of the avenues that the government is then now going to use to increase its tax revenue.
I see. Okay. And now that we're on VAT as well, I don't know whether I'm the only one who expected a more sweeping rationalization of the first and second schedules on exempt and zero rated. Because what I saw, or maybe we're taking lessons from the Finance Bill 24 and the protests, but I don't know. Let me start with Robert. What did you make of the proposals in the bill?
I think they were measured, Julians, and you're right.
Yeah.
If you compare the Finance Bill to 2024 and the proposals now, you can see a phased approach, which is very interesting because, government is saying we need to rationalize our tax expenditure and the VAT exemptions. So let's move the items from zero rated to either exempt or standard rated, and you can see a clear move with that. And they have done it gradually, which then begs the question: why don't we do some of these other things gradually? Because you also need these proposals to be acceptable. And I personally think that the category of items that have been moved to standard rated or zero rated or exempt, is reasonable, given what the government is trying to do in the sense of let's limit the tax expenditure. So I'm not surprised. I think would have been having a very different conversation when you had things like bread.
But fertilizer and agro inputs.
True. Although if you listen to what the CS said, which is very interesting, we're going to exempt fertilizers and then the inputs for fertilizers, which suggests that then you should not be, bearing the VAT. The only question that I probably have with that exemption for the inputs is we use electricity. Are you telling me that I'll go to Kenya Power and say, because I'm manufacturing fertilizer and that's an input, then don't charge me VAT? So I think there's some implementation challenge there, but the intention is clearly noble.
Okay. Adija.
I think for me there are those that were, because I was happy about, I mentioned in the beginning that I'm happy about exemption of VAT.
On transfer business.
But then I was happy from that front. Then when I open the bill again, I find that you've removed my exemption for bringing in a project and investing more than $3 billion. Again, you're telling me to pay. So the 16 I've gained from business concern, sale of a business as a going concern, I'm now going to pay it on the inputs that I'm going to use to start the business. So I find some of them are sort of like a double-edged sword. The government gives you here and then somehow finds a way to take away from the other angle. But I feel like Robert has said, I think it's clearly much, much better. But I know the big investors are going to find it a little bit rough because one, there's that provision that is about investors coming in and they're investing more than, is it 3 billion?
Yeah.
They will not be able to get those claims. There's the one is it aid-funded projects where manufacturers are not able to now claim a refund on supplies to aid-funded projects. That's also a big hit. So I find some of them are really targeting the big investors, and probably this can be explained by the complaints and the noise that has been around VAT refunds. So again, the government is like, if we don't have the resources to pay back refunds, then we'd rather, after all, say we are moving it from zero rated to exempt or to taxable, so that when we tax it at 16%, you're registered, you can claim it from the input side. So I think it's a balancing act that government is trying to find.
It's a give and take, and Honorable John Buddy did promise us to be a give and take. Edna, what do you make of this rationalization?
So, Julian, this rationalization actually started in 2020. If you remember when we had reduced tax rates, there was rationalization of the first and second schedule to the VAT Act. So I'm not surprised that it's not a very long list. But just speaking about the items that are moving from exempt to attracting VAT at 16%, you have items around services around the tourism sector, you have air ticketing, you have entry into national parks and national reserves. And just stepping back, just for us to understand what it means for a supply to be exempt from VAT.
Yep.
There are three people who bear the VAT burden. It could either be the final consumer, where VAT is there at 16%, or it could be businesses, where businesses are restricted from claiming the input VAT, or it could be the government, which is what Hadija was talking about, the zero-rated supplies. Yes. So in this case, where we are talking about movement from exempt supplies to supplies that are attracting VAT at the rate of 16%, it means that these businesses were actually absorbing the VAT. So my expectation is that there is a reduction in cost base, even as we are charging this 16%. So businesses should also be able to take advantage of this, so that it's not the entire 16% that is being passed on to the consumers.
Okay. Many of the skeptics I've seen out there around this whole rationalization have argued, look, this is exactly where we were in the build-up to the VAT Act of 2013. And we rationalized all this, then bit by bit, we saw this list becoming even longer than the Act itself. Robert.
No, I mean, and I think that's very true. If you look at what was known as CAP 476, the old VAT Act prior to 2nd September 2013, if you looked at the first and second schedule, it had over 400 items of exempt and zero rated. And you know, every year it kept on growing, every year it kept on growing. Some years, you know, you'd have probably 50 or 60 items coming in. And part of the rationale of coming up with the VAT Act 2013 was to limit those items. In fact, I think when the VAT Act first came out, I think it had 14 or 15 items in the zero-rated status. Today, I think we are at paragraph maybe 34 or thereabouts. So it's certainly grown. And the government now moving to exempt or zero-rated, to remove some of this zero-rating and the exemption, is trying to clean up. And I guess the question we have to all think about is, why do we even have to include these ones in the first instance? Yeah. Probably, and we've argued this before, Julius, probably the solution lies in a differentiated VAT rate. So don't zero-rate a product. For example, don't standard rate entry into game parks, but let's have 5%. You know, or basics. Let's have 5% VAT like they have in the UK, differentiated rate. So that you no longer have exempt products, and even if you're subsidizing, it's a limited subsidization.
But we had a differentiated VAT rate when we had petroleum products at 8%. And one of the arguments from GOK was, look, there's too much distortion around this thing. We need either standard rated, exempt, or zero rated, purely.
True, and you know, there's very good reason for that particular issue, because the issue was the oil marketing companies were essentially in a perpetual VAT refund, because they're incurring costs at 16% and then the output is at 8%. So there will be that mismatch. However, if you think about some of these services, you know, if I'm buying, say, tickets to the national park and then I'm selling them, it means my input is 5, my output is 5. Assuming you go that route. Yeah. So there are countries that have done it, and they have done it very successfully in a bid to cushion the lower income persons. Yeah. And I don't know whether there's a reason why we should not study some of those procedures or some of those things in other countries.
And maybe, Julian, I can add to that. Yeah? So I think the solution actually lies in the national tax policy. And if you look at the national tax policy, it provides for a framework for fiscal incentives. So the challenge we have had is that we do not have a framework to determine what kind of incentives are we going to have, say, from a VAT perspective. What goods or services are going to be exempt and which goods or services are going to be zero-rated. There was a very good intention in the national tax policy, and I'm hoping that the government is going to follow through to develop a framework, and in this framework to determine first what is the cost-benefit analysis, so that we are not introducing a provision this year, then next year we say, no, let's reverse it. So we need to do the cost-benefit analysis before the incentive is granted, during the implementation of the incentive, and there was also an intention that every 5 years, the government would then be looking at these incentives to see whether they have achieved the economic purposes that they were intended for. Then we also need to have sunset clauses. we need to say, fine, we are having this incentive for this period of time to cushion the vulnerable or particular sectors of the economy. So we say for the vulnerable in society, those ones can be there permanently. But for particular sectors, we probably need to think about sunset clauses.
Edna has decided that the national tax policy is the hill she will die on. So I want to switch gears to excise. I believe there's nothing more to add on that VAT for now. On excise, maybe let me start with Hadija. Are we reversing all the gains we saw in Finance Act 23? Because if you look at the changes in excise, they're just sweeping back to where we were in Finance Act 22.
I think we are reversing and more. we are bringing this bride. Last time it came in the bridesmaid's dress, the white dress. Now they've changed to the evening wear.
Yeah. Okay, clearly.
So clearly, I think, like I said in the beginning, I think excise duty is just that hit. And I know from principles, first principles, excise duty is supposed to be on specific goods. But at this rate, I think we are going to get to a point where we are just listing those goods that are not excisable. And they say, these items are not excisable, everything else is. Because every other time you find the ambit of excise duties, the list is just being stretched. And now I'm a bit worried about that new trend of starting on imports. Excise duty on imports of ABCD. Excise duty on imports of whichever item that is coming through. So I'm finding it a bit tricky, and I feel like it also needs a little bit of rationalization. When I look at, there were reasons why they had given some break to the usual culprits, the conventional excisable items, the wines, the spirits, the beers. First of all, there's a change in the way it is taxed.
Yes.
It is now per liter of alcohol from the liter of the whole item or the whole beverage, and that alone makes it more expensive. So if we are seeing that in the compressed economy that we had before and over the years, we've seen the revenues, the outcomes. I think when we look at the absolute, that last year we recorded a growth of $1 million, and it comes to 1.2, we feel it's a growth, but we are forgetting about the actual potential that it should have been if it was something better. So for me, I feel like we would rather leave some of these consumption goods, and like we've said, these are indirect taxes that people pay without knowing. You'd rather say, let's make the excise duty on such a beverage, even if it is per liter of alcohol, 22 shillings per liter of alcohol for the next 3 years. Then you'll find that there will be some bit of stability, and consumption will increase, which will then lead to increase in revenue, and then your corp tax, more jobs, more consumption because of the affordability and all. So I feel like there's really need to ramp up and think around the taxation based on excise duty.
Okay. And again, Hadija takes us to a very quick break. We shall be back when we'll be getting thoughts on excise from Edna and Robert, and then we'll switch gears to other things, including the significant economic presence tax. Stay tuned. Welcome to the last leg of this conversation on Business Redefined. We are unpacking the 3 bills, tax laws amendments, which have come forth for FY 24-25. Because of time, Robert, we're discussing excise before the break. Hadija has painted for us a picture. There is no predictability around what is subject to excise here. One of the notable changes is around alcoholic beverages and how they are subjected to excise. Give us more color on that.
Yeah, Julian, that's a good question. So number one, the base is moving because I think, for example, for beer, I think it's somewhere around 346 per liter, but now it's going to be 22 shillings and 50 cents per centiliter, and that's what Hadija was talking about. Now, I think the sector is not too worried about that, in my view, and as I understand it. I think the bigger issue is on some of the raw materials. So if you take, for example, spirits, you're paying spirits at, I think it's 10 shillings per centiliter, and then you're buying the raw material, which is 96% pure alcohol. You're buying it and paying very high excise duty. So for that segment of the product, there'll always be a a mismatch.
A mismatch
because,
of sorts,
yes, because you're incurring so much input, but then your output excess is lower. So I think that's number one. And then the second one, there's a very interesting proposal, if you read the law, that says that licensed small brewers will be paying 10 shillings per centiliter of these products versus 22
on the other side.
So there's a bit of we need clarity. Who are these small licensed brewers? How small do I need to be? Do I need to be producing maybe just 10,000 liters of beer a year for me to be small? We don't know that. So we need a bit of clarity on that. However, having said that, the point that Hadija made is very important because this is a sector that has always been hit. This one and cigarettes
and betting as well.
And betting as well, of course, and betting. So they've always been hit. And in fact, if you look at for cigarettes, the rates have gone quite high. But the last point I just want to make around excise, about policy inconsistency. So there's a proposal to impose excise duty on locally assembled electric vehicles. We're trying to move
the green transition.
Yes. So, and in fact, if you look at the draft national e-mobility policy, it says we shall give incentives, and part of those incentives are the exemptions. So then the question is, do we have some policy incongruence here? I think we need to have a look at that.
But Robert, still on the final point on excise, and because of where I work here, there's a new excise rate on advertisement on social media, on alcoholic beverages, betting, etc. At what percent?
At 15%.
At 15%.
Yeah.
So what do we need to do?
Well, Julian, that should not have come as a surprise to us. Why am I saying that? It's because mainstream media, when you carry those adverts, you are paying you're accounting for 15%.
Yes.
So what did the industry do? It
shifted
to social media. Yeah. And what does Revenue Authority do? You follow the money.
All right, let's close the chapter on excise then in interest of time. The switch from digital services tax to significant economic presence tax. Edna, take it away.
Yeah, thanks, Julian. So one of the things that we need to recognize is that there's a global focus on taxation of the digital economy. So in Kenya, we introduced digital service tax in 2021 at the rate of 1.5%. Now we've decided we do not want digital service tax. We want to move to significant economic presence. What exactly is significant economic presence? It means that we should be looking at the economic activities that are happening within a country for you to be able to determine what is the profit level of that particular entity. And this is particularly for the non-residents who are carrying out business through digital platforms. But if you look at the wording of the provision, it's actually the threshold for this economic activity, the significant economic activity, is one user. And it is actually pegged, the profit level is pegged on the turnover. And remember, DST currently is pegged on the turnover. It's 1.5% of the turnover.
Yeah.
So we assume that 10% of the turnover of the non-resident is actually their profit. And then that 10% is subjected to 30% corporate tax. So effectively, what we are saying is that significant economic presence is DST baptized by another name, because it's still going to be based on the turnover, but the rate has moved from 1.5% to 3%.
That's quite a steep climb.
100%.
And for the avoidance of doubt, who should be taking note of this? Because I've seen a lot of mix-up online in terms of who will really be subject to this kind of tax. Robert?
Well, I think it's anybody who operates or manages a digital platform. In other words, you are allowing people to interact on this digital platform. That's a focus of DST. And I think probably one of the things we need to have a debate about is, I think it's a good proposal because anyway, it's also global, by the way. But other countries which have implemented this have come up with thresholds. Is it about time Kenya also came up with thresholds? Because I could be just doing 1 million shillings, but yet I need to account for the tax. I don't know. That's a question that we need to think about. But it applies to anybody who runs a digital marketplace.
I see. There are those who have argued that, look, we have only had DST for about 3-4 years, and now we are again shifting to significant economic presence tax. Barring the fact that this is a global transition, do you think there's a question of predictability emerging here?
Well, I think, like a lot of these proposals, there's a question of predictability. Because my reading of the law also suggests that even locals will be subject to this DST at 5%. And you remember we had it sometime after COVID, and then it was removed because the rationale here was we're also paying tax at the end of the day, so we don't need this additional withholding tax. So I think we need to really have a look at the national tax policy, even as some of these proposals are coming through, and say, do we need this? Do we not need this? Do we need a study for this? How much is it going to yield?
Is that question of predictability here, Edna?
Yeah, I think so. And maybe just before I answer your question on predictability, when it comes to taxation of the digital economy, there are various players who are being targeted for taxation. So the first player, what we have just discussed, is actually the non-residents who are doing business in Kenya without a physical presence.
Yeah.
But again, the bill also proposes to introduce another layer of taxation where now we are focusing on the vendors who are doing business on these digital platforms. And some of those vendors are actually local.
Yeah.
So when you start talking about introduction of withholding tax, as Robert has talked about, so you'll have withholding tax on goods that are traded through a digital marketplace.
Yes.
What does that mean? It means that if I buy a good through a digital marketplace, there's going to be the burden of withholding tax. So what will the vendors do? They're likely to increase their fees. And then now you'll be comparing and saying, if I buy through a digital marketplace, it's slightly more expensive than if I buy through a physical shop. So we should also be careful not to send back the traffic to traditional brick and mortar. And again, there's also an issue of the rate that has been proposed. So if you're talking about 5%, and a number of these vendors are actually under the turnover tax regime.
Yeah.
They are taxed at the rate of 1.5%. So it means that they'll perpetually be in a refund position. So that is something that I believe should be looked at.
All right. Adija, anything to add on this significant presence?
I think for me, this significant economic presence tax, first of all, I think the regulations that brought them into being, in addition to the Income Tax Act, had listed a couple of services that would be subject to what we currently have as digital service tax. And these were the rider hailing apps, yes, the likes of the apps, the likes of some bit of software.
Yeah.
And then there were those exceptions of saying that if the services on a digital platform are already attracting withholding tax, then they shouldn't bear the digital services tax. But I think, like we all know, that the government is looking for revenue, and the uptake has been quite good. So I think when the government looked at countries like Nigeria that are already having the significant economic presence tax, they said, why not borrow this and expand the tax base?
Yeah.
I know it will, for sure it will, but I believe that there is need to look at those nuances of not really confusing the law as it already is, like what Edna said about those who will be in a perpetual refund position, and we know what a refund entails, and also the fact that we are targeting locals, and yet this is about digital economy, especially targeted at non-residents. So I think also the other thing is the predictability in terms of it moving right from 1.5 to 3. I think it's really a high hike, and the non-residents are already facing the VAT again at 16%. The government thinks that for the B2B, where someone can claim the 16%, is okay, but there's a lot of B2C activities, business to consumer activities, where actually one of the two parties, either you, the consumer in country, or the non-resident, has to incur that 16% cost. So when you look at it broadly in terms of the whole digital economy, there's quite a bit of pressure that is going to be put to the non-residents, and it may affect FDI and investment.
All right. Let me take one question from online very quickly here. Someone is asking that, Julius, you're asking about the change from the VAT threshold from 5 million to 8 million, which we have not seen. Don't you think that if everyone should be issuing eTIMS invoices, there is no need for a threshold after all? Any takers?
That's a very good perspective, interesting one. But I think the reason why we have a threshold is because it's a cost of administration of VAT. So if we say that everybody is going to be under the ambit of VAT, then we are going to be making compliance very expensive and very cumbersome. So that's why there's a threshold. And in any case, the threshold now needs to be revised upwards because it has been eroded by inflation.
I see.
But I think the other perspective also is that the eTIMS that was introduced is for an income tax obligation. where even if you are not VAT registered, you still have to issue the e-TIMs. So probably one needs to also understand that there is that bit where you have an income tax obligation, but then you're not VAT registered. You can as well have the e-TIMs without VAT registered. Yeah.
Okay. All right. Let's get to the last leg now. One of the interesting proposals, which was in the Finance Bill 24, it is also included in the Tax Laws Amendment Bill, is the question of infrastructure bonds and subjecting them to withholding tax. And Robert, I struggle with this. Why would you raise your own funding costs as a government?
Well, Julians, based on the data that we have seen out here, my understanding is that this was something that government was asked to consider by IMF. In other words, if we look at your investor profile, a lot of your investors are non-residents. And when you have these infrastructure bonds which are tax exempt,
yes, then
essentially you are depleting your tax base, and you're talking about expanding the tax base. So I think that was where this was going. Now, I'm still yet to understand why we then went for withholding tax on the local investors. I think if that was a concern, we should simply have said payments of interest on IFBs to local investors, tax exempt, so that you can also encourage the local investors. And then for non-residents, nothing stops us from withholding at 15%, for example. Yeah, and you give that opportunity to Kenyans. But like we were just discussing here, I think it's going to make the cost of funding more expensive for government, because if you look at the profile of investors, these are guys who understand, and they'll simply price in that additional cost.
Yeah.
So especially if government continues to borrow into the future, then that is going to be a bit more expensive. And perhaps Edna can explain a bit about that. There's a very nuanced provision around the withholding tax on those IFBs. Edna,
before she jumps in, in your scenario, where would a Kenyan who is a non-resident be placed?
Well, by definition, if you're a Kenyan citizen and you're in Kenya for one day, then you're a resident for tax purposes.
All right.
Yeah.
All right.
So for as long as you come to Kenya.
Edna.
Yeah, so Julian, the challenge that we have with the current wording of the law, for non-residents, it is clear that the rate of tax is 5%. For the residents, it is actually a withholding tax at the rate of 5%. If you're an individual investor, then that withholding tax is a final tax. If you're a corporate investor, there is no indication that that withholding tax is a final tax. So what that means is that 5% is actually an advance tax, and you'll be subject to 30%, and the 5% will just be a credit. So I think if the intention really was to make sure that both the residents and the non-resident investors are paying tax at 5%, again, would need to clean up that provision and indicate that this is a final tax in the hands of the resident investors.
And why would we have that sort of discrimination?
No, you see, the reason why we have this exemption in the first place, as you rightfully put it, is because you want to make the infrastructure bonds appealing to the investors. You want to increase the uptake and mobilize private capital. So the moment you then introduce taxation, then this impacts also your borrowing costs, and it also impacts the number of people who are going to take up the infrastructure bonds. And the government requires these funds to be able to do infrastructure projects in the country.
All right. Ladies and gentlemen, we are out of time. Let me just give each one of you 30 seconds, if you can, to give your closing thoughts. Hadija.
I'm appealing to the government to stop at where we are, not to pull out the Finance Bill 2024 and pull out whatever is left there, only the good ones. But anyway, I'm hoping that and calling upon the public to come and participate in this, because there's still a lot that needs to be polished.
Let me stop you there. Robert.
Let's implement the national tax policy.
That's it. Edna, your closing thoughts.
Should we be having finance bills every year? Why not once every 2-3 years?
Already you know Finance Bill 25 is coming.
No, that's a question that we need to be asking ourselves. Why do we have finance bills every year?
Unfortunately, we have to close it on that. I can see we have some breaking news on your screen. Sorry we didn't catch it up, but there you have it. And James Smart will be up next with more details on the same. Thank you for being part of this conversation. We shall be here next Tuesday on A Similar Business, so stay tuned.